Hi everybody. This video show introduces macroeconomics, starting with our very interesting circular flow model and introduces you to the basic idea of GDP. What is macroeconomics all about? It's not individual markets, it's how the economy operates as a whole. And so all the sum of the parts actually has a new dynamic, which we're going to see how that operates differently than individual markets, and other issues like about prices and unemployment and growth and imports and why, and really the issue of equity, why people are poor. Is it an unfair system? That sort of thing. Therefore, with all these issues at stake, there are some broad economic goals that most governments have in place. Everybody wants to have a real growth of income and sustainable, and a generally price stability, low inflation. That means really full employment, but we'll find out that that's just low unemployment. A favorable balance of payments, more trade, but make sure that it doesn't get out of balance. And equity when it comes to distribution of income so that we don't have people lagging behind in our society while a lot of people are enjoying great wealth. Now, you may recall what we learned in microeconomics, and that is we have a real flow of goods and services that are made by firms that flow into households, and the money flow in return is the consumer spending. Alternatively, there are resources that are flowing as well in our labor and capital markets, etc. And that's going from the households. They own them. The firms buy them in terms of income. So we have our basic money flow of incomes going to households and spending going to firms. And now we're going to expand that a little bit. So in the formula so far, a little lopsided here, but the Y represents the word income because we already have a letter I for investment. And C is consumption, which is consumer spending. And there we have the producer sector, or the firms in the upper part of the diagram, and the lower part, that house is representing households. And what we is that we have had consumption equals income. But in fact, the macroeconomy is a little bit more complicated than that, and that's where we get different types of money flows occurring. We actually have beyond consumption, there's a subtraction. There's a subtraction taken out of the consumption there. Not all income is spent. That's what I'm trying to say. Some of it gets saved into banks and financial institutions. And yet those banks and financial institutions are the source of a new money flow being injected into the firms in the form of investment. Another withdrawal, we'll say, is taxes that go to the government, and indeed that's definitely before any consumption takes place. And so therefore the consumption formula now shows that in fact there's these two subtractions from our income, and of course the direct taxes go to the government, and the government, however, doesn't just take in taxes, they also spend money. And that's called the government expenditure, represented by the letter G, and that is money flowing into firms as well, and they will buy products made from firms. Finally, we also have flowing into firms exports, because if the goods are being sent overseas, the export receipts, which is the money flow, see this is all about money flows right here, and that money flow will come into firms. And alternatively, when people in the consumption of goods and services will spend on firms, some of that is imported and it goes directly from the firms to where they are sourcing their goods from overseas, represented by the letter M. So that is also another kind of subtraction. It doesn't get subtracted out of the consumption formula, but here's what we have now. Those three the three withdrawals are being taken out of the economy here. And meanwhile, we've got three other flows of what we call injections coming into the economy. And that's where the whole economy generates the total amount of income that it's earning actually. So here we now actually have the formula of all this money flow coming into the economy. All these injections plus consumption. So consumption, or C plus I plus G plus X, and there we subtract the M. And therefore all the money flows are accounted for in this formula. And that's about it. You need to memorize every flow, every money flow here, and every sector. So there's the overseas sector, government, banks, households, and firms, and all the money flows going into them and out of them. And you've got yourself a good understanding about how money circulates in the economy. And from that, we get what we call the expenditure method to calculate the national income. And that is also what we call GDP, gross domestic product, which is all means really the total amount of spending by a domestic economy. And that's why we subtract the import spending there. And there's a good definition. It's very key to be recognizing every term here, like the market value, which means whatever the current prices are going for. It's the final goods and services. That means no more products being bought by firms to add on. It's the final product being made. It's being produced within a country at a certain given period of time, usually 1 year. So all these elements are very important for that definition of GDP. Memorize that too. Now, that said, there's actually two other measures of national income. We had the expenditure formula just as I explained, but on the flip side, there's the income method as well. It doesn't have a formula as such, but it is the sum of all the factor incomes that we have even seen in the two-sector fifth circular flow model. And then there's something called the output method, which is something that you can look at. It was very easy to check. I won't be talking about it anymore in this video, but it's just the added output levels of each level of the economy before the final product is being made. And all of these should give you the same amount of the national income method. So, just in summary, we want to explain that we have our basic two circular flow model, and that is what we call the core of the economy, really. And then we throw in the financial sector where money is flowing out of households in the form of savings, comes back in the form of investments from the government sector, which shouldn't have appeared until now, but there we go. It's direct taxes going in. Now, I'll also see that we have transfers, which is like so government support, income government support coming back into households, which is also something you can consider. And also firms have indirect taxes that they also have to pay in the form of corporate taxes, etc. Any GST would pass through that level from firms, actually through the government consumer spending. Part of that is GST or VAT, and then the firms has to pass that back on to the government. And then of course the government spending is included as an injection. And finally the overseas sector, where there's import payment flowing out and export receipts flowing in. And there it is, the overall kind of government circular flow model. And that's another just a way of arranging it. So the one I showed you before really is supposed to match this one here. It's just another layout, and either one is suitable to memorize. So I hope that's made it more understandable. And this is a very, very good conceptual model to be able to analyze everything in macroeconomics throughout the whole section. So be careful to be sure you memorize that.